Hey, it's Colton Armstrong, and welcome back to Wealth Without Banks Creative Real Estate. In this video, we're covering Chapter 12, which is all about the assumable mortgage. Now, while this isn't one of my top methods because it still requires lender approval and you have to qualify for the mortgage, there are situations where it might make sense, especially if you're wholesaling. An assumable mortgage is when the buyer takes over the seller's existing mortgage terms, including the interest rate, balance, and remaining repayment period. Instead of securing a new loan, the buyer assumes the seller's current mortgage. This can be especially attractive when the seller has locked in a low interest rate, offering an opportunity for the buyer to step into a better financing situation. However, since you still have to get the lender's approval and meet their qualifications, it's not always the most convenient method. But if you're wholesaling, this could be a great way to get a buyer into a safer version of a subject to deal while taking advantage of an already favorable interest rate. For a buyer who wants more security in the transaction, this approach may offer peace of mind compared to a standard subject to deal, where the mortgage stays in the seller's name without lender involvement. In a high interest rate environment, an assumable mortgage can make a property more attractive for buyers who want to lock in a lower rate, especially when compared to current market conditions. And from a wholesaler's perspective, it adds value to the deal because you can offer buyers a way to access better financing terms while still structuring the deal creatively. To sum up, while I'm not the biggest fan of assumable mortgages due to the lender approval process, this strategy can work in certain cases, particularly when you're wholesaling or when a buyer is looking for a safer option with great interest rates. In the next chapter, we'll dive into equity sharing, joint ventures, another creative way to structure real estate deals by partnering with others to share both the risks and rewards. I'll see you in Chapter 13.